Okay, so let's move on to the next piece of the podcast then. We're going to be talking about investing across the interest rate cycle. What have we got on this, Damien?
So this was born out of the observation that if you look at markets in 2023, so we're talking about equity markets in particular, the markets where the investors think that the respective central bank is nearing the end of its rate hikes, those markets have tended to do better. So that means the US stock market, particularly tech stocks, but the UK has lagged because that is a market where people are seeing increased rate hikes, and the expectation of further rate hikes are there, further aggressive rate hikes, more so than we are expecting in the US. So you're seeing that the FTSE 100, for example, is lagging things like US equities. And so that comparison between expectations of where interest rates are likely to be in different markets, that divergence between monetary policy of different central banks is quite telling. If we are closer to the peak of UK base rates than we were, say, 6 months ago, which we presumably must be, then the performance of markets is probably going to change as we start to go into a world of maybe a pause in base rate hikes or they being cut. And if that's the case, and we think we're closer to that peak rate and therefore a change, a pivot, then could we preempt that and change our portfolios to benefit for a world where there is a pause in rate hikes following a whole series of aggressive rate hikes like we've seen, or potentially when they're cut? So what I did is look at how markets have behaved in past interest rate cycles, so where we've had hikes, pauses and cuts in the base rate in the UK. Now, you've got to bear in mind that the base rate in the UK is not the only factor that influences investment markets around the world. There's a whole host of them. You can just think recently you had the pandemic, you had the dot-com bubble bursting, you had the Ukraine war. There's going to be lots of things and moving parts that impact what happens to investment markets. And also you've got other central bank policy going on as well. But in the UK, don't forget the base rate when it moves has a significant impact on our economy, on inflation. It also has a big impact on currency moves. So normally when the base rate goes up, it starts to have a positive influence on sterling versus other currencies. Not always, but typically it would do. And of course that then has an impact on the performance of assets that we invest in abroad. Because don't forget that if you buy something abroad, you've got to convert it back to UK currency, so the pound, and therefore that has an impact. If you buy something in the US and it's in US dollars, whether it's shares or other assets, if you then convert that back to pounds, but the pound has rallied, then the value of your investments can actually theoretically go down, even if the asset itself, the price in dollar terms, hasn't fallen. So it has to take all that into account. So what I did for 80/20 investor members would look at the period in particular from the mid-90s up until today. And we had a couple of periods where interest rates were hiked, where they were pulled back, they were cut, and where we had a pause. We had two pauses really. But if you remember, after the financial crisis, rates were cut aggressively, and then they've been hiked aggressively now. But there have been other periods, like just after the dot-com bubble burst as well. So I looked at how markets performed in each of those phases, and then even worked out the annualized performance of different asset classes. And the way I did that is I looked at the performance of different unit trust sectors that exist. So that include things like commodities, North American equities, UK equities, different types of bonds, so global bonds, for example, or UK corporate bonds or UK gilts. And by looking at all these different asset classes, you could see, is there a pattern? And there are some patterns amongst them. Of course, I can't give it all away on the podcast because it wouldn't work because it's a bit of visual medium, because I've got some nice heat maps, but also 80/20 investor members for the subscribers, but you can take out a free trial. But I'm going to give you some of the edited highlights. So during periods where there are aggressive rate hikes, then some of the assets that have tended to outperform have been commodities. So over the 5 periods that I identified where rates were hiked aggressively, then commodities had an annualized return of nearly 18%. So the performance was strong. And if we think about why could that be, then one of the reasons could be because if the pound rallies, because interest rates have been increased, then if the pound moves higher versus the dollar, then that will mean the US dollar index fall, so a measure of the strength of the dollar, it weakens. And when the dollar weakens, that's good for commodities because most commodities are actually priced in dollars. So that is one reason. But also, if we are in a rate hiking cycle, it could be because the economy is booming, in danger of overheating, in fact. So if that's the case, then it could be that the commodities are in demand. But another thing is that if inflation is high, and that is one of the reasons why the Bank of England may be hiking rates in these periods, then commodities are a good hedge against inflation. And we saw that to a certain point last year in 2022. And that might explain why commodities did quite well. Other assets that tended to do quite well were infrastructure funds. Now, they're funds that tend to invest in things like, it could include assets that are inflation protected. It could be things like toll roads. It could be certain kinds of construction, energy projects, things that often have inflation-linked revenue streams. So they tended to perform quite well. The things that did badly were almost exclusively bonds. So if you looked at global bonds, UK corporate bonds, they tended to do particularly badly, and also gilts. So UK gilts were one of the worst performing sectors alongside global bonds, and that will be for two reasons. Gilts, they have a high sensitivity to interest rate movements. It's called duration. And so when interest rates go up aggressively, it means that the value of those gilts falls more aggressively than, say, other bonds with lower duration. And in terms of global bonds, it's probably partly because, yes, bonds do badly in a high interest rate environment, but because of the strengthening of the pound, it would mean that that currency conversion would actually be to the detriment of any global bonds that you had. So they were some sectors that did well and badly during that environment. So I'm not going to dwell on any others, but that gives you some insight. Now, the other place that did quite well was UK smaller companies. And I think part of that reason that UK smaller companies funds outperformed, say, the larger cap funds that were out there. So, I mean, large UK companies, so things like in the FTSE 100, is probably because when interest rates were rising, the pound probably rose too. That would mean that import costs, things they imported, would fall because the pound would buy more things from abroad. And also the economy was probably quite buoyant, like I said before, would be in danger of overheating. That's typically across these different periods. Now, the one period where that wasn't true was last year. And that was probably because inflation was the overriding reason why the Bank of England was actually raising rates. It wasn't because the economy was booming, it was because of inflation. And if inflation is getting out of control, then it can be for the smaller companies out there that rate hikes start to impact them more aggressively because their cost of debt, their cost of their borrowings goes up, but also they might find it more difficult to pass the additional costs onto their customers than, say, large companies do. So we've seen supermarket prices go up, but more local companies, smaller companies perhaps, find it more difficult to pass on the rising costs onto their customers. So that is an interesting dynamic. If we want to look at the periods where rates pause, so let's say we have an aggressive hiking cycle that we've had, but then rates don't immediately fall. They sit higher for longer, like the Bank of England has suggested this week they might do. What happens then? Well, commodity prices tend to do quite well. Again, that's probably because the economy is still going okay because they haven't had to cut rates aggressively to try and stimulate it. But also they continue to be an inflation hedge, so inflation might be proving sticky. So commodities do tend to do quite well, but also financial stocks. And it's interesting that they do, at this point, perform better than they did during the rate hiking cycle. What happens during the rate hiking cycle is that as interest rates go up, banks, as we now know, if you look around you, the cost of mortgages is going up, the cost of loans is going up, the interest rates they charge, but the amount of money you're getting on your savings isn't going up as aggressively. The margins, the profit margins at banks are increasing. And you've seen people criticise banks in the last couple of weeks for this fact. So on the way up, the margins are increasing, but when they're at their peaks, you've paused, that's when their profit margins are probably at their widest. So they haven't had to pass on the savings rates, increase interest rates for savers, but they've taken the full profit that's been enabled by raising the interest rates on their loans and mortgages, for example. So the annualised return for financials was about 30%. It's significant when we went through a pause period. Another type of asset that does quite well are property funds. So I think property benefits from people thinking, right, interest rate hikes aren't going to continue, and if they don't continue, then hopefully that will be good news for people wanting to invest in property. Now, in terms of what happens when rates start going down, I'm not dwelling on all the details I've said. You need to look at the heat maps yourself, but I want to give you an idea what happens when rates start to come back down. Now, this seems to be a damage limitation exercise because bonds do well, global bonds do well. It's the counter to what we saw before because you get the currency kick now, because if interest rates are being cut, probably the pound is falling in value against other currencies. So that means that you get a currency boost on any assets you own abroad. So your bonds that are getting a benefit from rates being cut, but you're going to get that currency kicker for global bonds. And lo and behold, which asset does particularly well in a world of falling interest rates? Well, if you listen to the earlier part, you'll know that will be UK gilts because they get the flip side of the movement in interest rates. This is positive for them. Now, the damage limitation part is that equity markets tend to do pretty badly. Now, you would sit there and think when we see interest rates go down that, yeah, it often in the short term is a boost to equity markets. But when you get aggressive rate cuts, it turns out that the impact on markets is negative because there is normally something going on in the background. There's a black swan, maybe like the financial crisis or the dot-com bubble bursting, or there is some economic disaster unfolding that's caused them to cut interest rates, and therefore that will mean that people become risk averse and they start selling out of equities, but also those valuations of those equities will probably be overstressed because the earnings will start to fall, so people don't want to pay as much for them, so people start selling out and they move into safer assets like bonds. But one of the areas that does quite well as well, relatively, is cash. And the reason cash starts to perform is because you can lock in at the point where we've been at elevated levels of interest rates, but if you've locked in at that point and rates start to fall, then when other things start to tumble, your high interest rate that you've locked into then looks very attractive and will be one of the stronger assets. So eventually, obviously, cash, once we get back into that cycle again where rates are falling and we start to get back into perhaps a lull period that we had in the last decade or so where rates are low, cash is one of the worst assets you can hold in terms of inflation. It's eroded by inflation aggressively during those periods. So you can see that every type of asset tends to have its day, and throughout that cycle of rates going up, rates pausing and rates falling, sometimes you don't get the pause, they just go up and down quite aggressively. You can see there'll be a pivot and a change. So if we do get this pivot, this change, then what it means is we could see some significant differences or changes in performance of assets going forward. So what we see during this part of the year may be quite different towards maybe the beginning of next year when the base rate, if the market's predictions are correct, goes on hold or potentially starts to fall as we go through next year. But of course, if you want to find out more, you can take out a trial of 80-20 Investor. But this kind of investment cycle, investing for a cycle, will give you a overriding direction of where assets might be heading that you can apply to a portfolio if you analyse it. But in the shorter term, there will be macro events that override all of this stuff. So you get things like the Ukraine war, a pandemic like I mentioned. But it is interesting to see that as we shift from one regime to another, that we may see a big change in how parts of our portfolio start to perform, and potentially bonds could start to have their day again.
Okay, so just before we move on then, Damien, I'm particularly focusing on commodities and also UK smaller companies because you focused on that in a lot of your research. Do they behave differently on the way up and on the way down? What's the sort of insight into that?
Yeah, sometimes assets don't perform in direct opposites in different cycles. There's a little bit of mixed performance, but they're an example. On the way down, commodities tend to, not always, because it depends on the macro stuff as I mentioned, on the way down they tend to underperform and actually will lose money. And part of the reason is probably because like a black swan event will happen, and the reason they are cutting rates is to stimulate economic growth. And if the Bank of England's doing it, it probably means that other central banks are doing it because there's some global economic crisis. And if there's a global economic crisis, that means there isn't a demand for commodities for people to build stuff, so commodities fall. And on smaller companies, smaller companies are domestically focused, so they tend to be those companies where their customers are in the UK, whereas you get the all companies sector, so things in the FTSE 100, a lot of their customers and income comes from abroad. So UK smaller companies are influenced by the economics of what's going on in the UK. So again, if the Bank of England is cutting interest rates to stimulate economic growth, that means probably the economy is slumping and is in a contraction, and probably we are in a recession. And so therefore that will be bad for companies that are based in the UK who service customers in the UK. So UK smaller companies will be one of the worst places to be during that aggressive cutting cycle. But then we come out the other side and it all starts to change again.